Look at the geopolitical landscape right now. We've got, a 10-day Israel-Lebanon ceasefire holding, and President Trump is reportedly working on a treaty in Islamabad to secure Iran's enriched uranium.
Right, what do you call the nuclear dust?
Exactly, nuclear dust. So the immediate threat of an oil shock is basically gone, which gave the Federal Reserve room to breathe, and the NASDAQ just ran green for 12 straight days.
Yeah, a massive macro relief rally.
But then you look at Bitcoin, right? It just hit an absolute brick wall.
Yep.
So welcome to today's deep dive, where we are mapping out this wild divergence. Why is this asset struggling when the global risk premium is just vanishing? And what does this friction actually mean for your portfolio?
It's such a fascinating paradox, honestly. I mean, you would expect the Fed having the runway to avoid hawkish interventions to just act as rocket fuel. But instead, we are seeing this intense, really localized market resistance.
It's been brutal to watch. I mean, the price action this week, it dropped down to around 73,000, briefly broke 76,000, but got violently swatted right back down to settle near 75,600.
The rejection at that threshold was aggressive.
Yeah, and the derivatives market is completely twisted right now. We saw over $356 million in short positions just eradicated, yet negative funding rates are persisting.
Which is wild to see.
Right. So traders are actively paying a premium just to keep betting against the macro relief. Why are they so stubbornly bearish?
Well, because those derivative traders, they're staring down this massive invisible wall of supply from legacy holders. If you look under the hood at the on-chain data, specifically the RHODL ratio, it just hit its third highest level on record.
Wow. And just to clarify, that tracks the balance of wealth held by veteran hands versus new buyers?
Precisely. So a high ratio means long-term holders control the baseline. And right now, those legacy holders are cashing out. I mean, they are distributing their old inventory directly into this current momentum.
Which creates that brutal ceiling at 76,000.
Exactly. It really didn't matter that we had $467 million in total forced liquidations hitting the broader crypto market. That just wasn't enough buying pressure to eat through the sheer volume of coins that veteran holders are dumping.
That makes perfect sense. I mean, it's like trying to fill a pool with a hose, but someone opened the main drain at the exact same time. The derivative traders see that drain wide open, which totally explains their skepticism.
Yeah, they aren't blind to the on-chain realities.
Right. But here is where the story shifts. Because while retail derivative traders are fighting this bloody battle at 76,000, traditional finance giants are just quietly bypassing all that short-term noise to capture the underlying supply.
They really are. I mean, this is not just about trading volatility anymore. You are watching a fundamental structural shift in who actually owns the asset class.
The scale of it is staggering. Charles Schwab, they manage over $12 trillion, just rolled out spot crypto trading with a 75 basis point fee using Paxos for custody.
Yeah, that's a massive entry.
And at the exact same time, MicroStrategy bought another 17,585 Bitcoin for $1.3 billion. Plus, the spot ETFs absorbed over $332 million just this week alone.
The mechanics of that Schwab move are what's really crucial here, though. By charging a defined fee and handling custody through a regulated entity like Paxos, Schwab is offering this sanitized, frictionless entry point.
Right, for massive pools of traditional capital that would never dare touch a decentralized exchange.
Exactly. They are basically building a paved toll road right over the chaos of the crypto ecosystem.
Which is brilliant timing for them, honestly, because the decentralized fringes of that ecosystem are actively shrinking. Look at the UK. The FCA is mandating strict authorization by 2027, explicitly excluding crypto from traditional financial insurance schemes.
The regulatory walls are definitely closing in on the fringes.
And then there is the legal squeeze. Circle is facing a class action lawsuit right now because they failed to freeze USDC during the $280 million Drift protocol hack by the Lazarus Group.
Yeah, that lawsuit is the perfect example of why institutional capital is flocking to the safety of a Schwab or a BlackRock. The decentralized space is just facing an existential legal crisis right now.
I have to push back on that Circle lawsuit, though. The plaintiffs argue that because Circle had the technical ability to freeze the funds, they should have done it. But if a decentralized protocol is legally forced to freeze assets without a formal law enforcement order, doesn't that just completely break the foundational premise of decentralized finance?
It absolutely does. I mean, it exposes this really deep contradiction in the market right now. You have an ecosystem that fiercely resists traditional financial control, But the second a massive hack happens, those same participants demand TradFi-level restitution.
You want the security blanket, but not the rules.
Right, you really can't ask for the safety of a centralized authority while simultaneously claiming to operate a permissionless protocol. That underlying tension is exactly why capital is migrating away from the fringes and straight into heavily regulated institutional wrappers.
So what does all this actually mean for your portfolio as you navigate this? Basically, you are watching a real-time structural shift. The macro environment is clearing up, and institutions are aggressively accumulating the asset.
Even as derivative funding signals just deep, deep skepticism.
Exactly. They're using this sideways chop to quietly build their positions, which leaves you with this to mull over. As regulated giants like Schwab absorb the everyday retail flow, and regulators strictly fence in decentralized protocols, will the original peer-to-peer vision of this technology even survive? Or is it destined to become just another highly managed, heavily insured ticker symbol in your standard brokerage account?